Hello, good morning everyone. So today I'm going to explain about the futures, which is one of the derivatives. Okay. So as part of futures, I will explain you like what are the kind of futures are present in the stock market, how to trade also, and also what are the features like it involve like the what is in my spot market, how the calculation been done. Okay. So let me share my PPT for that. Okay. Okay. So basically this future contracts like which are uh, the underlying will be any asset class. Okay. It could be equity, it could be any physical commodity. Okay. So underlying basically if the rate of that underlying increase, the value of futures also increase. Okay. So suppose you want to buy the TCS share or Infosys share, which is underlying. Okay. So if you buy in spot market, okay, so it will take 3,000 rupees or three, whatever the market price of that share. But suppose if you want to buy the future of that underlying, it will be less. Like you have to pay only you have to pay only 5 or 10% in futures. Okay, and whatever the price fluctuation happen, okay, it is linearly related to the whatever the price of the spot market underlying. Okay, so here the buyer and the seller have the obligation. If you go into the futures derivative, if you buy future or sell future, you will have the obligation. But in case of option, there was no obligation to the buyer. He has the right to buy or sell. Okay, so that is the major difference. The obligation is there. If you have bought it, then on the expiry date, okay, you have the obligation to buy it or sell it, but it is only on the expiry date. Like if you trade, like it is tradable on the secondary market. So if you feel like you want to exit the position in futures, you can buy or you can sell it off. Okay. So the futures contract detail the quantity of the underlying asset and are standardized to facilitate trading on the future exchange. So the here the quantity is considered as the lot size. Here you will have to buy the futures in suppose 150 shares or 250 shares of TCS. You cannot buy one share or two shares. And this lot size is determined by the exchange. And this futures can be used for hedging and trade speculation. Okay, so for hedging, I will give you example. Suppose you buy 100 shares of TCS, okay, and its price is 3,000 rupees. Okay, 3,000 into 100. That will be the contract value. If you buy in spot market, suppose the it is from 2 days, it is going into the profit. Okay, on third day, some news comes up, and because of that news, you think that it will go down. Okay, so you don't want to sell it off, but you wanted to keep that uh, position in your uh, portfolio. For that, you can do one thing. You can sell the future. So it will be considered the hedging position. So in a spot market, when you have purchased the TCS share, that will be losing the money, and the future which you buy it, okay, it will have you like it will gain the money. So it will work like this. And for trade speculation, like if you believe like the TCS share will go up or down, then you can buy the future instead of buying in the spot market. So you can buy more in quantity. These are the terms which is used for the futures. So spot price, I have told you, whatever the price of underlying in the market is called spot price. Lot size also like this futures comes into lot size like 150, 250 shares. Okay. The contract value will be the market price into the lot size. The margin is the big concept here. So I will explain the further slides. So margin required for futures is is dependent on the uh, various factors. One is like volatility. So I will take this up later. The other one is expiry. Okay. So here the expiry is also like future contracts expires in 1 month, 2 months, and 3 months. Mostly if you go to the market, okay, if you have zero the account, upstock account, any broker account. So if you see like the TCS will have, or the Infosys will have three contracts for futures: near month, mid month, and far month. Near month will be like which will be expiring in 1 month, mid month will like expiring in 2 months, and far month will be expiring in 3 months. And mostly the last Thursday of each month will consider as the expiry date. Okay. And the future pricing formula is used, can be used to understand like what should be the price of the future. Okay. So maybe you see on the stock market, the price of the future of Infosys, suppose now January is going on, January 2024. Okay. So if you see the price of Infosys Jan 2024 is, suppose we take example of 1,000 rupees. Okay. And by the formula, it should be like 1100. Okay. But from the formula, it is coming as 1100, but from the market, it is only it is at 1,000 rupees. So you can buy that position. You can take the future because it is there's a difference. Okay. And the instrument types could be stock futures, index futures. There are multiple futures which you can buy. Same thing is described here. So lot size, which I told you, then the duration 1 month, 2 month, 3 month, which is called near month, middle month, and far month. And expiry also, like the last Thursday of their respective contract month, it will get expired. Same here also for the I have written for index stock futures and index futures. But in case of like index future, you cannot buy those stock on expiry because index is something which you cannot buy. So there will be a cash settlement. So physical settlement is only possible in case of stock futures, and open position index future can be settled by conducting a opposite transaction. So basically it will happen as a cash settlement on the for index futures. Now comes the margin part. Okay, similar to option here also required the margin. Okay, so the margin is basically comes like from the span and exposure margin from the exchange side. Okay, and this value of initial margin varies daily as it depends on the future price. Okay, this initial margin is come as a percentage of contract value, and this contract value equals to futures price into lot size. Okay, this span margin is the minimum margin blocked as per exchange mandate, and exposure margin is the margin blocked over and above span to cushion for any M2M losses, mark to market losses. Okay, and this both the span and exposure margin are specified by the exchange. So at the time of like initiating a future trade, the client has to have this span plus exposure margin in his broker account, in his brokerage account. So the exchange blocks the entire initial margin, span plus exposure. Span margin is more important between the two margin, as not having this in your account means a penalty from the exchange. Even you cannot hold the position. So if the this span margin, which is also called as maintenance margin, okay. So if it is like if you are not having that span margin in a portfolio in your broker account, so the position will be get closed by the broker. Okay. So both the buyer and the seller of the futures agreement will have to deposit the initial margin amount. So in case of futures, both the buyer and seller are depositing the margin amount. But in case of options, the buyer was giving the premium, was giving some premium. After that, he will not giving any other margin and all anything. But in case of futures, like if the margin get reduced after the M2M losses, then they again have to push money into this account, both the buyer and the seller. This mark to market is the margin which I told you. It decided on the basis of the position. Okay, suppose you buy something on today at 1,000 rupees, any future which is at 1,000 rupees. Okay, at the end of the day, the price has reduced to 900 rupees. Okay, so 1,000 minus 900, 100 rupees loss. Okay, so this is a this is not loss in your, it will be reflected in your profit and loss statement, but the position which you will be holding on the next day, okay, it will be open, the position will come as a 900 rupees. Okay, that will be updated, and then again the same day close price, whatever the close price, if it is 700 or 1,000 rupees, that will get updated on the next day again itself. Okay, so basically this mark to market will be based out of position of the previous day and the difference of it. So the previous day closing price figure is taken to calculate the current mark to market. This span margin is based on a statistical concept called VAR, value at risk. It basically means that the initial margin should be large enough to cover the loss of your position in 99% of the cases. This span margin, the uh, exchange will be providing 6 files, one in the beginning of the day, one end of the day, and 4 file comes in a day while market is open at some interval duration of time. Okay, so this will tell you how much margin a broker should take from the clients while taking the position. This is span margin, and for exposure margin, it will be like 2% for stock futures and 3.5% for index futures. And this initial margin is based on the potential maximum loss in a single day on the portfolio. Greater the volatility of the stock, greater the risk, and therefore greater is the initial margin. Okay. So exposure margin, like additional margin, it will be around 2, as per my understanding and as per my knowledge, it is 2% for stock futures and 3.5% for index futures. And if as I told you, the span margin, which is also called as maintenance margin, if it is reduced on a day, if it is not there, then the broker will uh, call the client to give them margin of keep the money in his account. That is considered the margin call. And if it is not done by the broker, like if he has not given the money, then the position will be get closed from the broker. This is a future pricing formula. Okay, so from here you can get what should be the price of that futures if you are going to buy. So this RF is the RBI's 91-day treasury bill as the proxy for the short-term risk-free rate. This risk-free rate means if you want to take this RF, you can get it from the RBI side. Okay, just go to the RBI side and there will be this risk-free rate. D is the dividend and X is equal to number of days to expiry. So this X by 365 factor will come more, like will be more, and then the spot price into whatever the multiply get increase. So like it will inference like the near month will have less future price compared to the far month. Far month will be the uh more what we say, like more premium or more premium you have to pay for the greater one. Okay. If the future is rich to spot, then the future is said to be at premium, else it is to be a discount. Okay. Final, how the settlement, like, so on the settlement day, it is similar to like what I told you, mark to market. On the expiry of the futures contract, NSE clearing marks all the position of clearing member to the final settlement price, and the resulting profit loss is settled in cash. The final settlement of the futures contract is similar to the daily settlement process. Okay, so the final settlement price here uh, is being taken like whatever the close price of the day or the final settlement price. In case of like everyday settlement, the last closing price. Similarly here, instead of closing price, they are call it as a final settlement price. Okay, then final settlement loss profit amount is debited or credited to the relevant clearing member account on next day on T+1 day after the expiry. And these open positions in the future contract will exit after the expiry day. Means after the means today is the expiry day. Will it once the market is closed, it will be closed or it will not be visible. That future. Okay. Mm, mm. Okay. So I have explained you about the futures. Okay. The main concept of futures is like basically in the mark to market. Okay. And apart from this, like if you find any difficulty to understand the futures in detail, or like if you want to understand something more, you can comment on the video. Okay. Then I will explain you. Now that's all from my side on the futures. Thank you.